In today's video, I am going to be comparing XEQT, which is a fantastic ETF, up against VEGT, which is another great ETF. These are both Canadian ETFs, so let's get down, let's check these out, and see which one is actually better. So what is VEQT? VEQT is an all-equity ETF portfolio, which just basically means it holds an absolute ridiculous amount of stocks. The only issue is it does distribute the dividends annually. It's not something that's going to distribute dividends every month or every quarter. So if you're looking to get dividends, this is definitely not this ETF for you. However, the MER is not too bad at 0.24%. And its 12-month yield is 1.32%. Basically, the fund highlights is it seeks to achieve its investment objectives by primarily investing in equity securities. The Vanguard ETF may do so either directly or indirectly through investment in one or more exchange-traded funds, ETFs, managed by the manager or an affiliate or certain other investment funds or underlying funds. So basically, other Vanguard funds. The last distribution was 46 cents, you might as well say, and the fund was incepted, or the first day of trading was January 29th, 2019. Anytime that you see the growth of $10,000, that's kind of a good benchmark that a lot of people will go by, and you'll see, oh wow, it started at $10,000 and it goes up to 20 or 12,500. That's a big, huge, massive 25% increase. However, there is an issue with this, and that is including dividend reinvestment. So keep that in mind. However, the asset allocation is, of course, 99.93% stocks, 0% bonds, and short-term reserves, which is essentially cash, is 0.07%. They would obviously use that cash to pay out people who, of course, sold the ETF, but also that still collects interest if that's still actually a thing these days. So the allocation under the underlying Vanguard funds is about 42.5% in US stocks, and that's through their ETF. And then they have also the Canadian All Cap Index as well at 29.8%. They also have the North American Index, which is essentially combining these two together at 20%. And then they have emerging markets, which is a little bit riskier, but that's where some of the growth is going to be coming from. And that is at 7.5%. So considering that it's only 7.5%, it's not a massive part of the portfolio. I really do like to look at market allocation, which actually comes down to the region as well as the country. And as we can see, about 42% is the United States, 30% roughly is Canada, 4.8% is Japan, and then of course China, which is what I'm really just not very happy with. But either way, 2.7%. So considering how risky China is to invest in, that is part of the emerging markets region, and at 2.7%, I wouldn't really be all that worried. Of course, Taiwan, this part ticks me off, but either way, 1.3%, the whole province of China, it's not a province. They are their own country. However, again, part of the emerging markets. Maybe they're doing that to make some Chinese government happy so that they can have their investments in China. But either way, when I see stuff like that, it just turns me off on the whole name altogether. When it comes to the sectors, it's going to be very heavy in technology and financials, but that is the majority of the North American market as it is. And then it's going to be followed up by industrials and, of course, consumer discretionary. Healthcare and energy are also going to be probably higher growth areas in my opinion. And when it comes to the actual stocks, this is essentially what you would be looking at, and it's going to be pretty much all North American stocks. Apple is obviously the largest company in the world. That's going to be number one. Shopify is the largest company in Canada, so that's going to be number two. I'm kind of curious why Microsoft is all the way up to number 3, but when it comes to Royal Bank of Canada, they are usually fighting for the #1 spot with Shopify in Canada as the #1 stock, a #1 company in the country. And so it's a really good mixture. You're getting higher dividend options as well. They're all established companies, at least for the top 10. And when you look at the chart, you can see that it was around $25 5 years ago. It's now sitting at around $35 a share. So there's a good increase in value. Of course, that would have been an absolutely fantastic time to buy. Remember, anytime that there's a sharp decrease in high volume, just buy a little bit at a time and just ride it all the way to the bottom, buy a little bit more, and then of course ride the wave all the way back up. That's just how you invest. Next is XEQT iShares Core Equity ETF Portfolio. This, again, same idea, is going to be essentially to invest in the whole entire North America and generally world as well. Some of the key facts is, of course, when you start looking at distribution, it is quarterly. So, of course, if you are looking at it as a dividend play, you're getting it quarterly, and you are only getting 1%. So, again, you may be running it as a quarterly dividend to be able to get your dividend, but at the same time, it's only 1%. So, you would really want to basically reinvest that dividend so that you can have higher growth into the future. It is also a much lower management fee. Its management fee, MER, is only 0.2% instead of 0.24%. It again will only invest in its own other ETFs. So this one as well will be US stock, Canadian stocks, as well as this one does have the MSCI index, which is financials, as well as the MSCI emerging markets as well. And of course, it's going to have Canadian as well as American cash. Now, its top holdings are actually a little bit different. So Microsoft is somehow #1. That to me is quite interesting considering Apple is the largest company in the world. And then going down to Shopify and Royal Bank, basically in the same spots as the other ETF. Amazon is up there as well. This is a little bit of a higher growth name considering where it is on the list, as well as TD. I think is a high growth stock alongside with Bank of Canada as of right now, mainly because we've learned that banks are going to make money no matter what. Altogether, the top 10 stocks are very, very strong. We have to remember that Enbridge is going to be in both as well, but with Enbridge, I really like the fact that it's a good green play. Enbridge is actually starting to invest more and more money into green technology, with it being invested into solar panels, wind farms, things like that, electric distribution. A lot of that is starting to be highly invested in with Enbridge, so it's actually a good future play too. And the exposure breakdown is heavy in North America as well. We're going to still see a lot of the emerging markets as well as Europe, but I do like how China is a much smaller percentage in this portfolio, and because of that I would actually prefer the iShares portfolio over Vanguard. We've seen some pretty good growth as well, from $20 to $26 over the last couple of years, so it's not all that bad. Personally, I would prefer the iShares option, which is XEQT, mainly because it's not going to have that high risk when it comes to China. It's only 1%, 1.7% of the portfolio, while being well over 2% in the Vanguard fund. So because of that, I personally would prefer iShares, but remember to do your own research. Don't trust a random person online. Do your own research. See if you're willing to take that extra risk to go into China. There could be a high reward with risk, so keep that in mind. I hope that you've enjoyed today's video and the breakdown of these two great ETFs. I'll see you guys again next time.